This conference will now be recorded.
Well, good afternoon, folks. Paul Kilby here. I'm going to be taking us through this webinar this afternoon on financial KPIs. So you've still got about 5 minutes, so time to grab a cup of coffee or similar, and I'll see you back here shortly. Thanks, everyone. Well, welcome, everybody. Good to have you along. There's a good number of us in the room. I see Roderick. Nice to see you again. I spoke to you yesterday. And let's have a look. Now, forgive me if I don't pronounce your name correctly. Nkosi, Alajamoke. I think that's probably Not a good one, but anyway, Monica, welcome. Mazen, welcome. Who else we got? Ferras is here. Abdul Jalil is here, and so am I. So that's awesome. So you're very welcome. It's good to have you all along. We're actually recording this, just so you know, for anyone that needs to consume this after today. So you know, we're going to record it. Well, we are recording it now, so that you can either watch it again at your leisure, or someone that's perhaps not here today can start watching it as well. Okay, so there we go. That's the idea. Anyway, yes, Nkosi, I see that. Thank you very much. It's good to have you along. All right. So look, I know some of you maybe, I don't know, and there's lots of beeping going on here in the background. So I'm expecting quite a few more to show up, perhaps. So anyway, let me just quickly introduce myself. My name is Paul Kilby, and I'm going to be taking us through this webinar this afternoon on financial KPIs. I've got to let you know my background, really. I'm an engineer. That's where most of my career has been spent. So I've worked for many telcos in the UK, well, all of them in the UK actually, all of the mobile ones, only all the cellular ones. And I've worked for many operators all around the world. So I spent about a year or so working in Canada. I've worked in California for quite a while, done some stuff for the American Department of Defense in Maryland, on the other side of the US, on the East Coast. I've traveled a lot in the Middle East. I go to Kuwait probably, I don't know, probably 6 or 8 times every year, to Bahrain and to other places in the region, into Africa too. A bit of time in South Africa as well, in Joburg and Durban, and a little bit in the Cape and so on. But since the lockdown happened, it's mostly been at home. So I've been working from home mostly since March, doing stuff online just like this. I do a fair bit of stuff for law enforcement. So as an expert witness, and you know, advising the police and so on various things. I'm working on a particularly nasty murder at the moment, looking at cell site information and doing cell site analysis, and depending on how the accused actually pleads, whether they plead guilty or not, I may have to go to court and explain all that evidence to the jury. So that's what I spend much of my time doing. But this afternoon, I mean, why am I talking to you about financial KPIs then? Well, I've got to tell you, back in 2007, 2008, I went back to university. So I did it part-time. I went to Cranfield University and I did an MBA. So I'm really an engineer, but with a veneer or a covering over the top, which is sort of management science and finance and marketing and those sorts of things, operations and that sort of stuff. And I really enjoy that aspect to it. So although I can dig deep technically if I need to, I'm very happy dealing with these more general issues, things to do with, you know, whether or not a company is going to be around next year or not, and thinking about strategy and how we're going to execute and all those sorts of things. Okay, so that's my background really. I live in the UK, so we're just coming into winter time at the moment in the UK. Well, not winter, it's autumn really, but it feels like winter today. So lots of rain, lots of frosts and things like that. So that's where I'm at the moment. I know that some of you are in much more desirable places in the world right now. So there's some of you I know are in much hotter, sunnier places than I am right now, when I'm very jealous of you. So anyway, we're going to talk about financial KPIs this afternoon, and that's what we're going to be going through. This has very recently been updated, so we've put in some new financial benchmarks in here, and they are from the first quarter of this year. So they're actually very fresh off the press really. So there's a little bit of a delay with these financial KPIs, and we'll talk about that actually. A lot of the financial data that we have is already well out of date. So if we're looking at an annual report for a company, maybe that was published back in April, and it probably talks about stuff that happened over a year ago. So that data that we're reading about today in the annual report is probably getting on for 2 years old already. So it's a bit of it's like trying to drive your car, trying to run a business like this is like kind of like trying to drive your car just looking through the rear view mirror. And it's not it's not a good way for avoiding accidents, is it? Let's be honest. So we'll talk about that as we go through, okay? So that's the general thing we'll be talking about today, financial KPIs. And I'll try and make it as practical as I possibly can, okay? So let's have a look at some of these things. So the first thing to say is the official documents that are published in the annual reports. There are actually 3 main documents there. We'll talk about those in a little while. We'll talk about the sort of things that we should be looking out for when we read those sorts of documents. But we really have this balance sheet, and that's a statement really of all of our assets. So it's a statement of all the things that we own and all the things that belong to us, and we make distinctions between fixed assets and intangible assets, and all those. We make these kind of distinctions between them. Okay, we also not only does it say what we own, it also talks about what we owe. Okay, so it looks at all the stuff that's come into the business, all the investment that's come into the business. How is it sitting? Where is it sitting? Is it all sitting in stock? Is it sitting in the bank in cash? Or what's happened to it? Okay, so that's what the balance sheet is all about. It's telling us where all of our assets are, not only our assets, but also our liabilities. What do we owe? Those sorts of things as well. So things like debt and all those sorts of things are listed in there. Okay, so what else have we got? We've got this thing called an income statement. Now, some of you you're probably familiar with that term income statement. That's the sort of modern name for it. 10 years ago, when I was doing my MBA, we were perhaps more likely to call this a P&L, a profit and loss account. Okay, so either terms are okay, but income statement is probably the more modern term for it, and profit and loss account perhaps is a more traditional, old school kind of name for it. Okay, but it's up to you which you use, but depends on which image you'd like to present to the world. Do you want to be latest terminology, or do you want to show that you're a bit more traditional? It's up to you, really. So those were the 2 documents that we always used to have, but it's very easy to massage these figures. It's very easy to maybe make them appear to be somewhat better than they actually are. So the one thing that we can't really fake or manipulate, or well, it's much harder to do anyway, is the cash. So the statement is, the famous quote from the movie is, "Show me the money." And that's really what the cash flow statement is all about. It's showing what the cash flows are to do with our business. So again, the important things there are, we're looking at opening balances and closing balances, and the explanation of any difference between those 2 things. Spending our money on? Are we spending it on a new Bentley for the managing director, or are we, what are we doing with it? Are we repaying debt, or are we taking out new debt? All those sorts of things we can tell from these 3 statements. Okay, and we can reach some conclusions about the health of the business as a result of that. Now, if I said to you that our debt is $100 million, is that any good? Well, what's the answer? Is it any good? Is it good to have $100 million of debt? What do you think? Well, the answer obviously is, let me just have a cough, excuse me a moment. Sorry about that. The question is it good that we've got $100 million worth of debt? Well, the answer is, I would say, and stroking my chin as I say it depends. So, Paul, what does it depend on? Well, it depends on what we're going to do with that money. Okay, so it depends. Are we going to spend it all on, Range Rovers and good cigars, Well, that's perhaps not a good investment of the money. Or are we going to invest in some machinery that allows us to make $70 million a year for the next 10 years? In which case, it's probably quite a good investment. So it depends on that. What else does it depend on? Well, if my debt last year was 200 million and this year it's 100 million, then what is that saying? Well, 100 million, we're reducing the debt in the business. You might think that that's a desirable thing. Okay, so it really does depend. So just looking at individual figures in isolation are not that helpful. Also, it depends on the context, doesn't it? $100 million, if I personally was $100 million in debt and my ability to earn as an individual isn't anything like good enough to cover that debt, then that's a real problem. But is it okay for a company like Apple or 3Com or BMW or some large organization to have $100 million of debt? It's probably okay, isn't it? So often we'll express these numbers not as absolute values, but as ratios. And we'll talk about that a little bit more as we go through, okay? So there's lots of ratios that we can express. But again, a ratio on its own isn't that revealing. If I told you that my net profit margin was 5%, is that good or not? Well, again, we could look at a trend. Was it 4% last year and 5% this year? Well, if that's the case, it's a positive trend. But if my net profit last year was 20% and my net profit this year was 5%, again, that's a steep decline, isn't it? So again, that's important as well. The other thing to say is, how do I compare against the other people in my industry? If all of my competitors are making 10% profit, 10% net margin, then, and I'm only making 5, then that's not good news. I perhaps need to look at myself and my processes and decide what it is about them, what are they doing different to me that means they can make twice the profit that I can. Okay, and again, vice versa. If my competitors are making 2% and I'm making 5%, then perhaps I need to start thinking about how I can defend my position. Okay, so these things on their own are not that informative. So we're either looking for a trend, comparing ourselves with our own performance in previous years, or perhaps we're comparing ourselves or benchmarking ourselves against my competitors, other people who I am fighting with in my particular industry. Okay. All right. So there is a sort of a rhythm to this. There is like a process. There is a sort of a cycle that we go through. And for many businesses, this is a yearly event. You know, every year we do new budgets. Every year we do sales targets. We do all of that. And often they're based upon the targets we get for next year are based upon what we did this year. So maybe it's last year's performance plus a little bit of growth or something like that. Maybe it is. Or maybe we can assess from first principles. What do we need to be doing? Okay, so either way. So maybe we do that. We go fresh view. And we get a brand new view of what we think we should be doing. We use that information to make a plan, make a strategy and a plan, and then we go ahead and we execute that plan. Now, often businesses are okay at doing those first two steps. You know, often it will be, done by the senior management team or someone like that, done in an ivory tower, we say, somewhere away from the business. They'll come up with, some great plan as to how they think the plan should go forward. And then they go and try and pitch it to the workforce and the sales team and the marketing department, and everyone has a good laugh and they carry on doing exactly what they were doing last year. So often the place where we fail is in the execution of the plan. Now, there's lots of reasons why perhaps we fail to execute as we should. And, one of the ones I've just been hinting at there is perhaps the people that actually have to do this plan are perhaps not sufficiently involved in producing the plan in the first place. So some buy-in and some ownership of this plan by the people that actually have to go ahead and do it is perhaps a good thing to have if you want the execution of the plan to be successful. I've certainly worked for organizations where, we get, maybe the manager goes off on a training course, or that, the exec team goes and does a strategy session with a highly paid consultant, and they come back with some lovely looking charts and a brand new strategy for the company. And everyone sort of rolls their eyes a little bit and says, oh, don't worry, they've been on a training course. It's okay. If we just keep our head down, we just keep on doing what we're doing, they'll soon get bored, and we'll just be able to carry on just like we are. And that often happens. I've come across that a number of times. Okay, so people come back from a training course all excited about all the impacts that they're going to make, and their team sort of rolls their eyes a little bit and thinks, don't worry, this will pass. That's what happened last time we went on a training course. If we just keep our head down and keep going, then everything will be fine. So the execution of the plan is often the difficult part. The other thing that can hinder us in executing our plan is the lack of good information. So often we don't know if we're doing a good job or not until it's too late. If we just rely on those financials that we've just been talking about, that are the ones we're looking at today are probably 2 years out of date, getting on for 2 years out of date anyway. If we're trying to rely on that to decide if what I did last week was good or not, then we're probably not going to be successful. So in order to execute the plan successfully, not only do we need buy-in, but we need accurate and timely information. And that's what I want to talk to you about next, actually. So I don't know if many of you read lots of business books, but for me, every day is a school day. And I'm 55 years old now. No, I'm 56 years old now. Oh my goodness. I've had a birthday since the last time I did one of these webinars. I'm 56 years old, and still for me, every day is a school day. So I've got, I'm just going to put the camera on so I can show you this, the things that I have. I've got this little book here. This is the book that I'm currently filling up with. I'll just hold it up to the camera so you can see I'm not telling you lies. This is the stuff I'm finding out. At the moment, I'm doing a project on the forensic use of billing records. So I'm doing a lot of stuff in this area. I don't know if that's the wrong way around now for the camera, but I'm doing a lot of stuff with 5G. So again, this is the last book. This one you'll see is full. You can see I'm not making it up. It's all full, that book. And it's been filled up by me making notes as I'm reading stuff and learning stuff and reading a paper, about this or about that, or reading a new textbook or something. So every day is a school day, and it's been like that for me for a long time. Actually, I don't mean to brag about it or say how great I am, but I would recommend it as a strategy, as a career, or even as a life strategy. To jot down the things you find out that are helpful and are useful. So if you look at my bookcase, I won't show you that, but there's probably a half a meter of these books, all full of useful information. I don't go back very far and read them. Perhaps I should do that. But what I'm saying is, we should always have a book on the go. We should always have a book that we're reading. We should always have something that we're trying to find out more about. And drip, drip, drip every day, a little bit of a drip, drip, drip into your brain, feeding your brain with good stuff. That has a cumulative effect over the years. So I would suggest it served me quite well, actually. So I would recommend that. You're probably a lot younger than me. You're probably a lot earlier in your career. So you could make a real impact in your life by adopting some approach like that said you're going to feed yourself some good stuff. And there's this good book. I was reading this. This is probably about 18 months or 2 years ago. Grant Vernon actually put me onto this book. So I get a lot of stuff from Amazon. I've got a Kindle now as well, which really helps. So it's called The Execution Gap. discipline of getting things done. So very good, very good. So there's a few good quotes in there. And I'll just put a couple in here. Organizations don't execute unless the right people, individually and collectively, focus on the right details at the right time. So what's that all about? Well, we say, don't we, that our greatest asset is our people. Is our people. Yeah, I've turned the camera off now, Eve. I'm sorry about that. I don't want to scare everyone. So I've turned the camera off, but hopefully you can still see my, oh, you can't see the screen. Let me try that again then. Thank you. The slides, thank you very much. Right, so hopefully now you can see that. I appreciate that. Thank you for sharing that. Much appreciated. All right, jolly good. Right, so organizations don't execute unless they have the right people, individually and collectively, focus on the right details at the right time. So there's a few parts to this. We say, don't we, that our greatest asset is our people. What do you think? Do you think that's true? It could be true. I would say not necessarily. Ain't necessarily so. I think the first job is actually getting the right people on the bus, getting the right people in your project. So the right people are our greatest asset. The wrong people are quite the reverse. Okay, so I think a big part of making a project successful, I'm kind of wandering off topic a little bit here. It's not about financial KPIs, but a lot of the success is baked in from the team that you have selected to be part of, you know, this project or this phase of growth or whatever you want to call it. So getting the right people on the bus is the right first step. So this right people, I think, is part of, you know, one of the most important parts of that sentence. And then it's about focus, isn't it? Now, focus means looking at the right stuff and perhaps not looking at the peripheral stuff, the stuff around it, which is maybe interesting, fast changing, maybe even exciting. But if it doesn't get us closer to our goal, then it's going to hinder our execution of our plan. Okay, so it doesn't matter how great the plan is, if the execution is poor, it's not going to have a good outcome. Right details at the right time. So that means timely information, okay, and the right details. Now, one of the big problems that we have today is just the sheer volume of data that we have to cope with. Okay, so there is an absolute mountain of data available to us today. Okay, and this is another good quote. I mean, my first proper boss, the first boss that I ever had that really took me under his wing and really mentored me was a chap called Richard New, and I'm forever grateful to Dick because he taught me a lot of stuff. And if you've not got people in your life like that, you know, I think you're missing out. So I think you know, you're looking for people that can help you get to the next place that you need to go to. And you know, that means being teachable and all those things. So I'm really grateful to Dick. He taught me a lot of stuff. And this is one of his favorite quotes, actually. That's why I put this in here. What doesn't get measured doesn't get managed. You know, Dick said to me many times, he said, Paul, if you can't measure it, mate, you can't manage it. And that's true. But the problem is that we've got so much data now, such a vast array of data. It's hard to see the wood for the trees. It's hard to see the right details that we need to execute properly because of all this other data that's in the way. So the next thing I want to talk to you about is this idea of a dashboard. Okay, so this is a good concept to be thinking about. So think about your car, all the data that is being generated in your car every time one of the pistons fires, and how much fuel it's burning and how much power there is and how many revs and what the temperature is outside, and you know what the temperature is on the inlet manifold, and you know all these different, you know, how bright the light is outside, and you know how much current is being drawn from the battery and what the voltage is and how loud the radio is, and all this data is there in the car, and it's changing every few milliseconds. Okay, So there's just too much for anyone to take in. So what do we do in a car? We have a dashboard, don't we? And what's that all about? Well, we have a few dials that show us important stuff. So what's the most important dial in your car? Well, probably if you want to keep your driving license, probably it's the speed that you're doing, okay? And that's right in front of me when I'm driving along. I can't miss it. If I get a speeding ticket, there's no excuses. I'm the only one that I can blame for that, okay? So why is that? Well, it's right in front of me. You know, that dial that says, and actually in my car, I'm quite lucky, it actually tells me what the speed limit is where I happen to be. So I've got no excuse at all. Okay, so if I did have any speeding tickets, and I'm not prepared to comment on that at the moment, okay, I don't want to say it out loud, but it's completely my fault. Now, what else have I got on my dashboard? I've got a few other things. I've got a little warning light that tells me when my main beam is on. So I've got a little warning to warn me if something happens. If something goes wrong with the car, maybe I'll have a warning light come on to say, hey, Paul, you need to put some oil in the car, or this car needs a service, or something's seriously wrong, take it to the garage, or stop driving now. So we've got some warning lights that perhaps really flash brightly if something urgent is going on. And I think we need a similar thing in our business. We need to identify what the critical parameters are for our business, and we need timely information that shows us those critical factors and not much else. Okay, so in this particular business, they're monitoring the profit for the day or for the week, however you want to define it. Okay, and you know how much of it is coming from direct sales. Well, that's looking okay. Oh, the channel profits are down. They should be much higher than that. So we've colored the dial red. And gross margin, hey, that looks quite healthy. That's right in the middle of the green area over there. We don't need to worry about that. So if I was looking at that dashboard, where is my eye immediately drawn to? The profit that's coming from channel sales, perhaps. This one, this dial here. So it's focusing my attention on the thing that needs my urgent energy putting on it. So there we go. So there's lots of nice tools that you can use to do this. Lots of nice tools. And I guess the only piece of work that you really need to do is to, you know, design it. Now, it doesn't even have to be that complicated. A few years ago, 2008, 2009, when I finished my MBA, I thought I wanted to be a project manager and a program manager. I was quickly divested of that of that ambition. I did it for about 18 months. It was fine. I quite enjoyed it. But what I had a little dashboard that I kept on the wall of my office. And all it was a piece of a flip chart, you know, like so a large piece of paper. I don't know what size, maybe A1, something like that, A0, maybe big piece of paper. And I just had it as a 2x2. So I had like a cross. And on one axis, I had ahead of budget, behind budget. And on the vertical axis, I had ahead of time, behind time. And I put a blob of blue tack on my piece of flip chart on the wall. So anyone walking into my office could see whether I was ahead or behind in terms of time, or ahead or behind in terms of budget. Now that sends two messages out. If my client came into my office and I was on the phone, he could look at my chart and see, hey, he's ahead of schedule and he's ahead of budget. Brilliant. I'll leave him alone. I'll let him crack on. What happens if I'm behind budget and behind schedule and I've put the blob there? If he comes in my office and I'm on the phone, what's he going to think? Hey, oh, I was going to tell him he was behind budget and behind schedule. Oh, look, he knows. Okay, I'll come back later. It's not urgent. He knows about it. He's probably dealing with it on the phone. So it's either very reassuring because I'm doing good, or it's reassuring because people are aware that I'm aware and I'm dealing with it. Okay, so it worked really well, and that was just a blob of blue tack on a piece of flip chart on the wall. So again, it doesn't have to be complicated. Those simple dashboards really can help. Okay, and it was part of being transparent as well, and making it clear to the client that I wasn't trying to hide anything. You know, it was I was being completely upfront and honest, and not keeping any surprises from him. Okay, because surprises aren't a good thing when you're a project manager, I would say. Maybe for your birthday, that's the only time you really want any big surprises, okay, as a project manager. I don't know if any of you project manage, but if you are, then you know what I'm talking about. Okay, let's move on. Let's talk about something else. Let's talk about something that's a little bit more sort of finance related. So dashboards are really important, and I'll bring these two things together. We'll talk about financial dashboards and things in a moment. All right, so we'll have a chat about that. That's where we'll sort of round off the webinar today. So let's talk about this. Let's talk about how we might go about reading an annual report. So let's just think about this for a second. So annual report, it's a requirement that they're published every year. Generally speaking, if you're a publicly listed company, you probably have to publish some financial data about your organization, and that's to keep investors informed. Also, the people that might want to do business with you. So that might be customers, or it might be creditors, your suppliers. So we owe it to them to provide financial details about our business. Okay, so they tend to be generated at the end of a financial year. So let's say we get to the end of March, maybe that's the end of our financial year. Then we've got a period of grace, a period of time, maybe 6 months or something like that, when we are able to do all the work to generate the report. So produce all of the glossy pages and the statistics and all those things. And then it gets published. So maybe a report for the financial year that ended in April could be published by the end of the year, let's say by December, something like that. Okay, so in December, we're reading about the year that ended in the March. So it goes back a whole 18 months. Okay, so we're going back, we're now in December, and it's talking about things that happened in March of the previous year. So very, very nearly 2 years ago. So that's one of the big problems with it. They are historic documents. And there's a whole branch of finance and financial KPIs and things, which are what we would probably refer to as management accounts. Now, these aren't necessarily published outside of the organization, but they're much fresher, they're much more up to date. You don't have to use the same rules and regulations to publish your management accounts, as long as everyone knows what they mean. They're for your own internal use. You can really publish whatever you like, and you're not really going to send it to anyone, are you? You're only going to internally circulate it, so that's fine. All right, so there we go. So unlike a financial statement where the format is typically laid out by the government agency, so that's the government, you know, the law would say it has to be like this. Annual reports can appear in many forms. So there are different, those financial documents have to be in a particular, presented in a particular way, but the report itself can, you know, there's a bit of flexibility there as to how that appears. But they generally follow a similar pattern. Now, earlier on, I mentioned that every day is a school day, and I passionately believe that. I really think so. And one of the things that you can do, and this is not going to cost you anything, but you can just go onto a company's website and you can order a financial report. So you can go onto Vodafone's website, and they will post you a copy of their annual report. And it arrives in the post, and it's, you know, probably an A4, quite a glossy thing. You know, keep it by the toilet. Spend, you know, every time you spend, you know, 5 minutes in there, just read another couple of pages of it and put it down, and then next time carry on and do this, whatever you're going to do, however you're going to do it. I don't know. Keep it somewhere where you pick it up for 5 minutes and put it back down again. Keep it by your bed, maybe not, but you know, it's not going to cost you anything, and it's really, really good to you know, just keep your brain fed with good stuff. So they are quite glossy. They are quite, how can I put this? They're quite flattering to the organization. There's good information in there, but often we have to look quite hard for it. Okay, often there's a lot of what's the word? There's a lot of spin on the information. Okay, so they tend to present the company in the best light possible. So I just want to give you a few tips of things that you might want to look out for. So what's usually in an annual report? Usually there's some kind of letter or statement from, it could be the CEO, it could be the chairman. The chairman's report perhaps is a little bit more general about the market, and maybe the CEO talks about, maybe a little bit more practical view of things. But there's some kind of communication like that from the leadership of the business. There'll probably be something like highlights from the past year. Okay, so there might be all the bits of good news, and sometimes they might have to look really hard to find some good news if they've had a tough year. But generally there'll be some good news in there. They'll find some for sure. They'll talk about what the goals and the plans are for next year, perhaps a little bit about what their strategy is going to be for the coming year. Okay, and that's a really important part of that document. I think you can really make some decisions if you're thinking about investing in the company. You can make some real decisions about whether or not you want to buy some stock in that business based upon strategy and the likelihood of achieving it. Then there will be the mandatory parts. There will be a balance sheet, there will be an income statement, there will be a cash flow statement. Okay, usually there is some statement of shareholders' equity as well. So how many shares are there in issue? That kind of thing. How many special shares are there? How many unissued shares are there? Those kinds of things. Okay. Then what you'll also have is you'll have a number of footnotes. Now, footnotes, what that might do, that might add some extra information to particular lines in the financial statements. So what they might do in the balance sheet, they might say, what the long-term debt is, so debt over 12 months. They might have a figure for that. And then there might be a little number next to it saying see note 37. So you flick through a bit further through the report, note 37, it'll give you a breakdown of all the long-term debt and when it matures and all those sorts of things, okay? And if there are any special items in there, there might be a little note, see note for 52, go to note 52 and it'll explain what that particular item is all about. So, when you're reading those financial statements, you've generally got one finger, propping the book open at a notes page, and then while you're reading the statement itself. So that's a big part of it. You get some footnotes in there as well, just some little notes about what's going on. Summary of corporate information. So a little bit about, maybe the team, the leadership team. What else could it be? The addresses and all those sorts of things. The contacts for investor relations and those various things as well. So again, that's useful information. They might have some analysis as well. So the first thing that your financial analysts are going to do in the investment world is they're going to work out all those ratios and so on, plug all those details into their analysis tools. And what they'll often do is they'll do a lot of that calculation on behalf of the financial market. They'll produce, here's a list of the 30 top ratios that you might be interested in, and this is what they were last year, and this is us benchmarked against the average of our competitors. So those kinds of things, they might do some stuff like that. Depends if that's good news or not. If it's not good news, you might find that is quite a thin section, okay? And again, I would say this is perhaps the most important thing. These financial, a decent financial report like that we're talking about here should have been audited by a set of independent auditors, and they will sign the document to say, yes, they believe that this report is a true and fair reflection of the state of the business. That's what they'll say. It's true and fair reflection of the business. Okay, so hopefully that's been signed by the auditor. Now, if the auditor declines to sign it for some reason, and occasionally you find that, you might have alarm bells ringing if if you're thinking of investing in the business, or if that company owes you some money. You might start asking questions as to why maybe that is the case. Okay, so I would be reassured, and generally it's true. Generally, the auditors sign the report, and give that assurance. Okay, that's our assurance that true. The figures have not been massaged. They're followed. Internationally recognised standards is the way that these sorts of things should be prepared. So that's all jolly good. So let's have a look at the bits of the report and the things that we should perhaps be looking out for. So the first financial statement is that of the balance sheet. So as we said earlier on, that's a statement of all of our assets and all of our liabilities really. And so we're looking for, as I mentioned, no single number in isolation is good or bad. What we're looking for are trends. So comparing ourselves with our performance last year, and if there are any major changes over the past few years, we're looking for an explanation. So if suddenly, our fixed assets have gone up, then that's not necessarily a bad thing. If that is because we've just built a 5G network and that's very expensive, or we've just rolled out 4G and now we're rolling out 5G as well, it might be a very good thing that our fixed assets have gone up. Okay, so there we go. So there are some ratios that we can calculate on our balance sheet. There's a whole suite of ratios that we can calculate for this. And that's really beyond the scope of this webinar. But there is another one, another webinar called the 3 Key Documents that Grant has done. And that's a really good one if you want to know about all those different ratios. Go and have a look at that, because there's a lot of good information in there. Right, so this next point is quite important. This idea of comparing ourselves with similar companies. So if I was Vodafone in the UK, who would I be comparing myself with? I'll be comparing myself against the other UK operators. So EE and O2 and Hutchison 3G and those organizations, okay? Just like if you're the Ford Motor Company, who are you going to be comparing yourself with? Well, I guess General Motors and BMW and Audi and all of those other, Volkswagen and all those other, Toyota and Mitsubishi and all those other large car manufacturers. So comparing yourself against other companies in a similar industry of a similar size. Okay, there we go. So watch out for this. If you see a big increase in long-term debt, okay, so and by long-term debt we mean debt over a year, then you need to be looking at the reasons why the debt is going up. Are we borrowing against future years' profits in order to plug the gap for big losses this year? So that is, that could signal big trouble. However, our long-term debt might be going up, as I've mentioned. We might be investing heavily in fixed assets that are going to produce lots of free cash flow for us in future years, in which case, it's perhaps a sound investment. Okay, now, if you were to look at my personal balance sheet, then most of my profit, most of my assets actually on my balance sheet this year are from profits from previous years. Then well, maybe that's not strictly speaking, that's perhaps not a good example, but what we're saying is if most of the assets are made up from profits of previous years, then the bottom line might not be as good as it first appears. So if we've got lots of retained profits from previous years, then our bottom line might look really good, but that might not necessarily mean that this year has been a good year, even though the bottom line might look absolutely awesome. Okay, so how would we look? Where would we look to see what this year's performance has been like? Well, the income statement will tell us exactly that. The income statement at the top will tell us what our revenue is for the year. So revenue is another word for sales, income into the business. And then from that, we subtract a number of things. So we'll subtract our cost of sales from that. Then we'll subtract the various costs that we might have. So our variable costs, things like staff costs and for all the chairs and the pencils and the cars and all those sorts of things, take all those costs off of it. Then of course we may have to pay for our debt, so interest payments and all those sort of things will come off. Then we might have to pay some tax. So we'll pay all the corporation tax that we have to pay. And then what we end up with at the bottom of our income statement is our net profit. Now our net profit might be $68 million. Is that any good or not? Well, that number on its own is neither good nor bad. We have to A, compare it with last year, and B, we probably want to compare it with our competitors. But what happens if our competitors are sort of different sizes to us? What happens if we're a massive company and all our competitors are small, or vice versa? We're competing with some massive organizations. They're not going to ever make 68 million a year. They're going to have 680 million a year. So how can you compare one with the other? Well, what we would tend to do would be to make it a ratio. So we'd divide net profit by sales, for example, and that would give us our net profit margin. Okay, so the income statement, if we look at the bottom line, and that's why we call it the bottom line, because they print it on the bottom line of the income statement, it tells us whether we made a profit or a loss. And it's much more useful to calculate margins. So divide our net profit by our sales gives us a percentage, gives us as a percentage our net profit margin. What percentage of our sales ends up being our profit? That's what it means. And is that going up? Is it going down? How does that compare with all of our competitors? All of that stuff is really good to know. Okay. Yeah, obviously, well, maybe it isn't obvious, but obviously we really want the bottom line to be positive. We want to be making profit at the very least, okay? And we want it ideally to be growing each year. So if we've got both of those things, we can't fail, can we? Can we? Can profitable companies go out of business? There's a thought to ponder. Can profitable companies go out of business? Yes, they can. How come? Well, they run out of cash. And that's one of the reasons why we need the cash flow statement. For some reason, there it is, cash flow statement. We need this cash flow statement. So cash tells us, as the name suggests, how much cash we've got. Are we able to, we say, wash our face? Are we able to pay all of our immediate bills? You see, we can't pay bills with profit. Income statement, all it tells us about is profit. Now, if you agree to buy something from me for $1 million, and I buy the stock in and I deliver it to you, then and I've paid $500,000 for it, my profit will show as £500,000, $500,000, whatever. Now, you haven't paid me yet, but I've still made a profit of £500,000. Now, unless you pay me, I'm not going to have the cash to pay the light bill or pay the DHL delivery person or next week's salaries. Okay, so lots of times profitable companies go out of business. Why? Because they run out of cash. So we need this cash flow statement so that we can keep an eye on that aspect of the business. Okay. Are they making investments? That's not necessarily a bad thing. Are they servicing their vehicles? Hopefully, yes. Are the investments they're making wise investments, as we've talked about? Now, also, the direction of the debt might be important. If the debt is relentlessly increasing, then that may be a problem. Okay, it may be. Probably is, actually. Or are they, over time, repaying their debt? Is the debt creeping down slowly? Again. Or is it stable? It might be fine. If it's stable, that's absolutely fine. So when that loan matures, just roll it over into another loan. So all you ever pay is the interest that's required, okay, on the loan. Now that's fine. That works great, providing that there's not a tightening of the credit market. Now that's what happened in the last big recession that we all had. What happened was there was the dot-com bubble, not dot-com bubble, I'm sorry, the subprime bubble that sort of burst, that started in America and then spread around the world. What happened there? Well, all the banks stopped lending money. So people that had debt, that the debt was stable and they're a perfectly profitable, healthy organization, their debt was fine, they were paying it, they were servicing it. And then when it came to time to renew, suddenly they could not renew the debt. They couldn't get a new loan to replace the one that they already had. So when the credit market constricted like that, suddenly people couldn't get credit. A lot of companies went out of business or got acquired because they were distressed and became vulnerable to a takeover because of that, because they couldn't roll the debt over into a new loan. So this is all very well. Stable debt is fine as long as the debt market is open and we can still sell our corporate bonds. Everything works fine. The moment it tightens up, then we might be in more difficulties. So those are the three statements, okay, and a little bit about each one as to what to look for. So balance sheet, we talked about. Income statement, that's the performance over the previous year, and cash flow statement, what's happened to all the money. Okay, helpful. So the next thing that you want to be looking for is some analysis of their strategy, and you need to come to some conclusion or some view as to whether or not you think it's a good strategy or not. So one of the places you can go for that is our CEO statement at the start of the document. So there you will hopefully get a fairly candid view of what's going on. You will also find, I've not put it here, I've not put it in this slide, but you'll also find often in the back of the annual report, you'll find a risk assessment or a risk analysis or some kind of risk log. Okay. So that's another thing that you can look at to see how seriously they're taking the various risks on the business and how they're mitigating for those various risks. So have a look at that letter. Now, for those of you that are from a law enforcement background, this is very basic knowledge for you, but the 5 W's and the H. So what's that? It's the where, what, when, why, and who. They're the W's. Where, what, when, why, and who. And the H, of course, is the how, right? So these are the good questions, these loyal serving men, right? Where has the company been and where is it going? So that's a good question. Where's it headed? What's the direction? What's the strategic direction that the CEO is setting out? What are the overall goals of the organization? You know, what is their strategy going to look like? What is their tactic going to be in the coming weeks and months as we go ahead? What are the overall goals? Okay, so when and how is it going to achieve these goals? So are these just lofty goals with no chance of being achieved, or is there some plan as to how it's going to be done? Now, why is the CEO taking this direction? And I have to let you into a little secret. Please don't tell anyone, because this really is very sensitive information. It's often the case that CEOs have big egos. There, I've said it. Now, hopefully that isn't too offensive to anyone, but it's true. Is the CEO pursuing this strategy because they are looking for, their ego to be to feel better? There was a very famous chap called is it Fred Goodwin? I think it's Fred Goodwin, but everyone knows him as Fred the Shred. So he was I think he was in charge of Royal Bank of Scotland back in the day, back in the 1990s, and through his hubris and ego, he basically crashed the bank. So all about his ego. He was an absolute perhaps I have to be careful a little bit what I say, but I don't want him to sue me or anything. But through his hubris, I think it's well known that it didn't end well for the organization. Okay, so is it because of that? Often CEOs have got big egos, and the thing that drives them to be CEO, is perhaps the same motivation that makes them want to be the biggest and the best and the largest and the whatever it is, the mostest Or maybe it's just to get their bonus. Maybe their bonus is linked to the share price of the company. So they will do whatever they can to get that share price up so they can leave with a massive bonus. Who knows? Why is the CEO taking the action that they're taking? Having said that, I'm not anti-CEO by any stretch of the imagination. You just have to be aware of perhaps who you're dealing with. Who's going to lead the company? Who is it? So who is this CEO? Do they have a track record of delivering success? Who is his technical team? Has he got a good finance director? You know, what's the R&D director like? Do they have good, corporate social responsibility credibility? Those sorts of things. So who's going to lead all this stuff? And that comes down to, is it going to be a Richard Branson organization? If Richard Branson's in charge, do you feel confident? You perhaps feel more confident that the company is going to be successful than if it's someone you've never heard of. Okay, so there we go. I won't say any other names. Fine. Right, so who's going to lead it? There we go. So shareholder requirements, I'll just do this and then we will go through some actual numbers just to round off our presentation today. So shareholder requirements. The shareholders are the owners of the business. So the shareholders are the people that own the equity in the business. Now, very often that might be some big pension, some anonymous pension fund somewhere or other, okay? Or it might be a family firm. It might be, owned between, two brothers or father and children or whatever it is. So who are those shareholders? And depending on who you are, depending on why you own the business, you might want very different things from the business. If you're a pension fund, probably what you want is reliable, predictable dividends. If you're an early stage investor in a tech company in Silicon Valley, you're not going to get dividends for some considerable time, my friend. You're looking for capital growth. And they're very different things, actually, very, very different things. So their requirements may be different, okay, depending on who they are, financial institution or otherwise. Okay, so generally speaking, shareholder requirements will always include an increase in value. So long-term, over the life of the business, long-term value of the business, they want it to increase. Okay, so the MBA definition, the reason we have a firm is to increase or to build shareholder value. That's all they used to say about that. Now, today things are somewhat more complicated because you also may have requirements to do with wider economic issues. So it might be some social enterprise, socially aware enterprise. So one of the things today might be that we have this commercial arm on our organization so that we can build wells in Africa or whatever it is. It might be that we want to, I'm thinking of a company at the moment that wants to send lots of bicycles to Africa. Okay, and they have a cycle racing team, and their role in life really, it seems to be to raise money to send bicycles to Africa. There might be other things, green issues. Is it important that we take green issues seriously? Well, I don't know if you remember, but there's an organization called BP, British Petroleum, as Barack Obama was keen to point out. And I think they dug about 100 oil wells that year. But sadly, one of them in the Gulf of Mexico, there was a fire and an explosion and several people died. And we ended up spilling billions of barrels of oil into the Gulf of Mexico. And as a result of that, well, lots of people lost their livelihoods. I'm not belittling that. But the impact on the business was, I think, about a third of the market capitalization was wiped off the value of the business in a matter of days. And we're not talking about a small business there. We're talking about one of the largest businesses in the world. So if we don't take this stuff seriously, then there are huge implications for the business as well as the human cost associated with it. There might be other issues, legal issues, ethical issues. There could be any number of issues. We might feel that we need to be very ethical and a responsible corporate citizen and take green issues seriously so we can attract the right kind of employee, the right 20-something employee that's very aware of those kind of issues and get them to stay in our business and contribute in our business. So we may have to take on a much broader view than just increasing stockholder value, shareholder value. Okay, right, so that's the general stuff. Let's get to the absolute meat and potatoes of this. I want to give you some up-to-date statistics that you can take away. So the first thing to say is time series data, and what we've got here is broken down on a quarter by quarter basis. And these lines here, they're perhaps quite revealing. We've perhaps not conclusive though. It appears that in the first quarter of this year there was an upturn in revenue. But what these graphs all actually demonstrate, I think, is the very seasonal nature of some of these statistics. All right, so just be careful of that. So you need to be comparing quarter one this year with quarter one last year. And actually, it looks like things are getting better, doesn't it? But when we compare ourselves against last year, actually, oh, it's not so good. It grew last year, it shrunk this year. Not so good. Okay. What about the previous first quarter? Well, it's about on a par with first quarter in 2018. So you need to think about the seasonality of this. Now, the remainder of my slides are taken over a 12-month period, but these are correct as of the end of quarter one, 2020. So I just want to run through some of these and just make some comments about each of them, if that's all right. So here we've got a breakdown of the total revenue for each of these organizations. Now, what does this tell me? The actual numbers up here aren't that important. I would suggest that this indicates the shape of the market. In economics, we would call this how concentrated the market is. Now, what it appears to me to be the case, that we have a number of very large organizations. So AT&T, Verizon, NTT, we've got China Mobile, SoftBank here, Deutsche Telekom. They are, how many is that? 3, 4, 5, 6, 7 that are, in a kind of a league of their own, head and shoulders above the rest in terms of their size. Then there appears to be a cluster from China Telecom, Telefonica, America Mobile, Vodafone, KDDI, Orange, and perhaps China Unicom I'd include in that, of a similar kind of size. So there's a bit of a cluster there around about that size. So a group that are much bigger than that. Then we've got a further 7, how many? 2, 4, 6, 7. So we've got a group of 7 big. We've got another cluster of about 7. And then what do we have? We have a very long tail. All right, so actually this isn't a very concentrated market. There's a relatively small number of very large players, okay? A cluster of maybe medium size, and then a big long tail of much smaller organizations. Now, if you were an economist, you might be able to take some views about that. You might decide that maybe this is ripe for consolidation, because economies of scale matter a lot in telecoms. So again, that might be a conclusion that you draw from this. Okay? But some of the companies here, I don't see them, some of these are national companies. STC, for example, I mean, they're part of the long tail, aren't they? But they're the Saudi Arabian telecommunication company. I don't see them merging with BT anytime soon, do you? Okay, or we can keep on going, can't we? MTN, for example, and the one next door, I think that's well, Swisscom. Let's compare it with Swisscom. Are they going to merge? Well, MTN, Africa, and Swisscom, maybe, but maybe it stays like this. I don't know. It would take an economist to actually comment on that, but presenting the data in this way, it gives us an idea of the shape of the market, and we can start to think about it in other ways. What else can we say about this? This is year-on-year growth. So what can we conclude about this? Well, some of these numbers are positive. There it is. Boom, down to there. And some of these numbers are negative. So this is growth. So it looks like there's a significant number that are growing and there's a significant number which are shrinking. So who are the winners? Who are growing the most? Well, that might be interesting. MTN look like they're doing pretty well. So did Turkcell. Now, this is only in terms of percentage growth. So this doesn't give you an idea of the actual size of the organization. It just shows you how successful they're being. Vodafone and Vodacom, actually, they're two related companies there, aren't they? There's shareholding of Vodafone and Vodacom for sure. They appear to be growing quite well, but they're quite a modest sized company, actually, when we look at the other graph there. So we can start to think about it in that. But what else can we conclude? Well, the total revenue year-on-year growth is actually negative, negative 0.08%. So overall, people are shrinking, which appears to be counterintuitive, doesn't it? Why would it be shrinking? Well, maybe it's the same number of people that are using the network. Maybe, in fact, maybe more people are using the network. Maybe the revenues are down. Okay, maybe the average revenue per user, or the ARPU, is down overall. That might be the reason for that. Okay, EBITDA. So EBITDA is something that we can read from our income statement, from our profit and loss statement. It is the earnings before interest, tax, depreciation, and amortization. So if you take the revenue, from that, we subtract the cost of sales and our variable costs and the fixed costs, okay? Sorry, I'll say that again. We take our revenue, we subtract our cost of sales, and then our operating costs from that, and that gives us what we call our operating profit. Now, our operating profit, another way of saying that is EBITDA. So the next thing that we would take off is interest, then tax, then depreciation, then amortization, and that gives us our net profit. So this is actually quite a useful measure in terms of the performance of the management team, because EBITDA will measure how the sales are doing, how the cost of sales are doing, and how the operating costs are moving. So it's a good way of assessing the performance of the management of the company. Now, the performance of the management of the company, they've not got much control this year about how much interest they pay, because that comes down to how much debt they took out several years ago. They certainly can't change how much debt they pay, how much tax they pay, sorry. That's up to the government. And the depreciation, that's how much capital expenditure they've done in previous years. Amortization is a similar thing to depreciation, but we do depreciation on tangible assets. We do amortization on intangible assets. So things like your software licenses or your telecom license to operate, for example, we would amortize that. So if the license costs $100 million and it lasts for 10 years, we would amortize it at $10 million per year, okay, over the life of the license. So anyway, it's a good indication of the performance of the management team. Now, we're saying that the industry standard for EBITDA is 29%. Now, that sounds like quite a lot, doesn't it? The problem that we've got is it needs to be that high, okay, because the interest that we're going to be paying is quite substantial, right? Because there's a lot of debt in the business, as we'll see in a moment. And also depreciation and amortization is quite significant as well, because we've got a lot of capital invested in the business. So it's capital hungry and therefore interest hungry as well. So once we take off those, the interest and the depreciation and amortization, it comes down to a much more modest figure, low single figures, as we'll see in a second, okay? Okay, net income margin. So yes, that's exactly this. So if we take off interest, tax, depreciation, amortization, what do we end up with? A net income of 3.5%. That means 3.5% of our sales gets eaten up. Remains as profit after we've taken off all of our costs. Okay, that means that 96.5% of our revenue gets eaten up in our various costs. Okay, of running the business and dealing with the government and all those things. So there you go. So EBITDA 29%, net profit just under 3.5%. So not great. The other thing to say is lots of capex. So if you divide the amount of capex by the volume of the sales, again, we've got a figure around about 15–16%. Now, some people are spending a lot more than that. So what's going on with Barty? That's a good question. So let's get Barty's annual report and see what they've been doing. So they've been spending a lot on capex over the last 12 months. So that'd be interesting, wouldn't it? So maybe they're investing, again, a lot more money in Africa, things like that. Or maybe they're just rolling out the network in India. Who knows? We could have a look, couldn't we? That's prompting a question. Likewise, MTN appear to be doing good. So, let's have a look at that. Okay, so there you go. So average for the industry is this. Some are perhaps not spending enough. Are Saudi Telecom spending enough? If you were thinking of investing in STC, you might be thinking to yourself, oh, are they being left behind? How is their 5G rollout going? How is their, do they have an IMS in all their territories? How are they doing? Are they spending enough? So again, that might be raising alarm bells, perhaps for a different reason. And again, presenting the data in this way, not quite a dashboard, but presenting it in this way, you can come to some pretty cool conclusions about it. Okay, so free cash flow, how are they doing? Free cash flow, so of their, if you divide their free cash flow, how much free cash they've got in the bank or cash or near cash equivalents, it turns out to be about 13.2% of their sales. Okay, so is that good or bad? Well, that's what the industry average is. Some people have got a lot more cash than that. So Etisalat appear to have lots of cash at the moment. So what are they doing with that? Well, let's have a look. Capex per sales, how are Etisalat doing? Are they spending it on infrastructure? Let's have a look. I don't see Etisalat listed there anywhere. Interesting. So they're not spending it on Capex anyway. Etisalat, here we go. Their net income margin. So they've got very, very good income margin. They seem to be doing really well. They're getting 20% income margin. So perhaps that's why they've got lots of free cash. But again, putting it in this way, it prompts those sorts of questions, doesn't it? What about these over here? NTT and Barty, they appear not to have much free cash at the moment, but then they are spending an awful lot of money on capex. So perhaps that's reasonable, but they need to have some free cash, don't they, in order to pay the bills. All right. So again, questions you need to answer if you're thinking of investing in Barty. What else can we say about this? Again, this is another view, isn't it, of the size of the industry. And again, we've got the same or similar 1, 2, 3, 4, 5, 6, 7. There's about 8 there. Actually, Vodafone are in that group now. We've got about 8 there. And then we have a further, well, it's really a long tail then, isn't it? Well, maybe 1, 2, 3, 4, 5, 6, 7, a further 8, let's say, down to BT. Let's be generous, which are in a sort of a mid group, and then we do have some kind of long tail going off into the distance. So again, that's confirming what we already know, and perhaps confirming some of those names as well. Net debt per EBITDA margin. So what this is flagging up for us is those that have the highest debt, and we're saying that the net debt per EBITDA is 2.0. Now 2.0 doesn't mean anything on its own, but we can compare where we measure up against that number. So there's a few of them. So these are average here, and some of them have significantly higher debt than the others. So generally speaking, lower debt is associated with lower risk. Debt is another word for risk, actually. If you have a fairly low risk business, you might be prepared to tolerate fairly high debt. So the risk in the business is coming from the debt rather than the technical risk of what you're doing. Okay, so if you were a company and if you were Vodacom in South Africa, let's say, well-established, healthy organization in South Africa, you know, to take on some debt, to do more of what you're already really good at, you know, maybe to invest in 4G or 5G, that might be a fairly low technical risk. So you might be prepared to borrow the money for that. But if Vodacom decided that they were going to start launching satellites into space, not their core business, much higher technical risk associated with it. Therefore, you'd want to have a very low financial risk. So you wouldn't want to be funding that from debt. You'd want to be funding that from some, you know, equity or something like that if you were gonna get involved in that project. So generally speaking, if you have high technical risk, you want low financial risk, and vice versa. If it's low technical risk, you'd be prepared to take on some debt to do more of it and get the rewards as a result. So you're happy to gear it up quite high if the technical risk is low. So leverage is the other way of looking at it. Again, it's the other side of the same coin. So leverage is all about debt divided by debt plus equity. All right. So yeah. So leverage. It's the gearing of it, and we're talking about, you know, a factor of 3 here as our leverage. So as an industry Andrew, so some of them are more highly leveraged than that. So again, if you're thinking of investing in those, you'd be wanting to ask the question why. Why is their debt higher than everyone else's? What is it that's special about them in that regard? Now, the other thing you can do once you've got all this data, if you want to present it in perhaps a slightly different way, you can start to do this sort of analysis, this 2x2 analysis. And every chart on my MBA, I think, well, not every chart, but many charts, the vast majority ended up being 2x2 matrices. Okay, so we've got 2 dimensions on here. We've got EBITDA margin on the vertical, and we have got we've got revenue growth on the horizontal. Now, it actually looks like most of them are pretty much. There's not many outliers here from an EBITDA margin point of view. Perhaps KT Corp, whoever they are, and SoftBank here. That's a bit of an outlier. I want to be asking about that. Maybe Etisalat here. Etisalat seem to be doing rather well, don't they? But their growth seems to be. Their revenue growth seems to be fairly static. So which would you rather have, revenue growth or EBITDA margin growth? I know which I'd rather have. I think Etisalat is sitting pretty there, actually. And we can identify some other outliers here. So Telecom Italia, they don't seem to be doing very well at all from a growth point of view, but from a revenue growth point of view, but they seem to be doing significantly better from an EBITDA margin point of view. So again, you can put these things into clusters quite nicely. Okay, so again, that's all I'm going to say about that. So thanks for your kind attention today. That's hour and 20 minutes. That's probably enough for me to be talking. I'm not in a rush though. If any of you have got very specific questions about anything I've talked about today, please feel free. Type your message in or unmute your microphone, and I'll be more than happy to go through it with you. Any questions at all? I'm going to mute my mic now and just see what happens. All right. So thanks for coming. If you need to go now, that's absolutely fine. But I'm going to mute my mic and I'm just going to sit here and see if we've got any questions at all. Okay. Thanks, everybody.